Good afternoon, my name's James Chutter and I'm the Corporate Account Manager from Leeds Building Society. I'm here today to talk to you about our retirement interest only proposition and how we've come back to the market. Before I go into talking to you about retirement interest only, I wanted to take you through a little bit about who we are. So we're Leeds Building Society and we are the 5th largest building society in the UK. We've got 60 branches spreading across the UK, the most recent of which we've opened in Edinburgh recently. We don't do any mortgage businesses through our branches, as we do 93% of all our lending through intermediaries. We've seen a 28% rise in mortgage lending since our annual results in 2017, which has mainly been supported by a really strong broker performance, so thank you for that. We've also seen a 12.5 reduction in our application to offer timescales. To put that into real terms, that's taken us from sort of 11 days down to between sort of 7 and 8, mainly supported by the fact that we've automated a lot of our back office processing, which we're hoping to see more of again next year. We've got 29 experienced BDMs spread across the phone and field to help you with your kind of regional challenges. And we've got over 100 different products, some of which we've been award winning, that cover off a number of different areas, mainly residential, buy-to-let, holiday-let, and shared ownership and help to buy. Shared open ownership and help to buy, probably what we're best known for. So the key objectives of the presentation today is to provide you with a background of RIO Mortgages, as they've only just recently come back into sort of standard mortgage advice. I'm going to talk you through what RIO is and who it's for, and then take you through the key features of our retirement interest only proposition. So to start off with, I just want to give you a really basic idea of what a RIO mortgage is, as there might be a number of different levels of experiences listening into the call today. So RIO stands for retirement interest only. It's a mortgage that is specifically for older borrowers. It has no set end date and is designed for people that are over the age of 55. Unlike standard mortgages, where the idea is that the mortgage repayments will pay off the loan at the end, or if you've got an interest-only mortgage which has got a repayment strategy in place, a retirement interest-only loan is repaid just based on a life event. When I say life event, I mean if they were to die, or if they were to move into care, or to move into care with a family member, and the sale of the property is the only acceptable repayment vehicle. So now that we've got a bit of an understanding of what RIO means, I want to take you through a bit of a timeline of some of the changes that have happened that have reason why RIO has been taken away and then brought back to the market. So if you take you back to sort of 1990 to 2000, endowment policies and interest-only mortgages were extremely popular due to the fact that the repayments were lower, and with the endowment policies the idea was that it was going to help pay off your mortgage quicker. Then in 2008 we had the financial crisis, which saw a lot of lenders reduce their propositions, especially in the interest-only market. We also had MMR happen a few years later, the mortgage market review, which saw lenders have to tighten their propositions even further and start to require proof of what the customer was earning and to show that it was going to be sustainable throughout the term of the mortgage. Then in 2014, the CML did some work around interest-only mortgages and found that there was 2.8 million outstanding interest-only mortgages. So they urged lenders to go out and start proactively contacting those customers to find out whether they had the right repayment strategies in place and it was going to be appropriate for paying off their loan. The 2.8 million starts to give you an idea of what the size of the market was at that time. Then in 2016, probably the biggest change which has happened towards retirement interest only, as RIO mortgages were being sold both pre and post the financial crisis of 2008, were that lifetime mortgages were reclassified to comply with the Mortgage Credit Directive. So this was where the retirement interest only was reclassified within lifetime mortgages, so it meant that mortgage advisors had to be qualified within equity release mortgages to be able to give this kind of advice. Now those firms that were historically doing a lot of retirement interest only mortgages, after a while went back to the FCA to let them know that this was becoming a barrier to them being able to serve their customers. This led to the FCA then researching more into retirement interest only, which happened around this time last year in 2017, and so that's when they released a paper regarding retirement interest only, highlighting that there'd been a lot of change since 2016 regarding how long customers were working for, and also retirement ages, and the fact that equity release wasn't the only option for them that was the most appropriate. So the FCA back in March of this year reintroduced retirement interest only back to within standard mortgage advice, so it wasn't creating a barrier, and to create more consumer choice. So now that retirement interest only is back into standard advice, I wanted to take you through whether it's really actually a standard mortgage proposition, because the FCA have, although they've reclassified it as a standard mortgage, there's a lot of other areas that need to be taken into consideration when dealing with this type of customer. So for example, the FCA have created a new set of regulatory requirements and redefine the term of retirement interest only. So those regulatory requirements are disclosing restrictions on residents within the property. By that, if you've got somebody who is, say you've got an elderly couple who have let's say a 40-year-old son still living in the property with them, that could be an issue for a lender, or legally, bear in mind that the repayment strategy of this mortgage, that the property is going to be sold, and so if you've got someone who's still living in the property, that could cause issues later on down the line. In terms of our criteria, we don't have anything in there that says they can't live in that property. However, it's something that your customer may want to seek independent legal advice for their own peace of mind. Now the next two, so disclosing potential impact on consumers' tax and benefit position, these kind of sort of roll into each other because they're regarding advised and non-advised sales, but it's disclosing what impact drawing down a large amount of funds could be to the customer's tax and benefit proposition. So if the customer was to draw down 50,000, it could have an impact on what benefits they can claim, and also what tax they may have to pay. So we always advise that the customer needs to get independent advice from either HMRC or a tax specialist to make sure that what they're doing is right for them and it's not going to have a negative impact. And then finally, disclosure that a lifetime mortgage may be available to them and more appropriate. To help you with these disclosures, we have a useful guide to our RIO mortgages, which has a tick sheet, and all four of those disclosures are included in that tick sheet, along with some other helpful tips for when you're completing a retirement interest only mortgage with us. So if you go onto our website and find that will help you take you through it. Another real key consideration for us when coming to the market with a retirement interest only proposition was vulnerability. So there's a number of different areas which could define the customer as vulnerable. We've looked at mental health, their sort of family demographic, and who they might be trying to borrow the money for. But in the end, we focused most of our research on the FCA's Financial Lives Survey of 2017, which showed us that 53% of 65 to 75-year-olds are more likely to demonstrate characteristics of vulnerability. That then goes up to 66% of 75 to 84-year-olds, and then that goes up again to 77% of those aged 85 and above. So although age doesn't define vulnerability, the older the customers are, we've found that they were more likely to demonstrate characteristics of vulnerability. So it's therefore been a real key consideration to our proposition, and we've put a lot of content up on the website of what to do if you find that the customer is in a vulnerable situation, but is still wanting to take your advice and also go ahead with the mortgage. So some of this may seem really simple and already general practice in your mortgage firms, but a few guidance tips that we came out with was giving the customer extra time. A retirement interest only mortgage is designed to go for the rest of the customer's life. That's a big thing to take in. So giving them time to go away and digest the advice that you're giving to them would be probably the first thing to do. Also getting the customer to go away and speak to their family about it. And making sure that if you've got a family member or friend or third party that can be with them all the way through the process, that can not only just help the customer but also to help you, the broker, in making sure that the customer's getting the right help and support for this kind of mortgage. On the flip side of that, something that was thrown up to us a little while ago is what to do if the customer is under duress from a family member and the broker feels that they're vulnerable and that there's a family member, I don't know, for example, who might have an addiction, and they're saying, come on mum, I need you to take this money out for me so that you can help me. In that sort of scenario, it could be useful for them for you to try and make it so that you can speak to the customer on their own, whether it be over the phone or to get them to come back in without that family member, or to refer them for independent legal advice. We don't offer any fees-free solicitors for these products, specifically so that the customer is urged to go and find their own solicitor and get independent legal advice about the advice that they're taking. So it also helps to support you in terms of getting to take a little bit of responsibility off your shoulders and share it with the solicitor, especially if you've got a solicitor that you work closely with, just so that the customer can make sure they're getting the right options for them, and also to help negate if there is anyone who could be putting pressure on them. The other thing would be to talk to the customer about having power of attorneys in place. The customers are allowed to product switch, but if there's a concern that the customer might not be in a mental state where they're able to deal with a product transfer later on down the line, and there's concerns that they might not be able to do that, then getting them to have a power of attorney in place early doors could really help with that transaction, most for the customer but also for the broker as well. As I say, I know that seems like in some cases common sense and quite basic advice, but it's something that we've taken a lot of time and consideration around, so we just wanted to share it with you. Again, all of those things that I've listed are on our website. So how does RIO compare to other mortgages? So compared to a standard mortgage, where the loan is due to, on a standard mortgage, the loan's going to be repaid over a fixed term, and you're going to be using capital and interest payments, and going to be doing an affordability assessment, compared to a RIO mortgage where the mortgage is going to go for the rest of the customer's life, so there isn't a fixed end date. It is purely interest only, and there isn't any, it's just done on a one-hit drawdown. The customer can't borrow any further funds, so if they haven't withdrawn all the money that they need, it's not often we would look to do extra borrowing for them later on. If they've had like their roof's caved in and it's an emergency, then that's something that we can look at on a case-by-case basis, but normally we wouldn't be looking to lend further to them after they've had the initial loan. Compared to a lifetime mortgage, so equity release. So with an equity release mortgage, the repayments are going to be rolled up within the mortgage. So I suppose there's no affordability assessment on that side of things, compared to a RIO mortgage where we are going to be looking to assess the customer's income over the full, basically for the rest of their lives. So we're going to be looking at how sustainable their income is. I suppose another thing to mention is that the rates are quite a bit cheaper for a RIO mortgage than a lifetime mortgage. Also, the age that a customer can take a RIO mortgage at, the minimum age is 55, and I know that for lifetime mortgages it can be required that they need to have a later age to be able to take out a lifetime mortgage. So I'm going to give you a real life example of something that's happened recently for one of our customers. A scenario was that the customer was they paid off their mortgage, but were living quite far away from their children and their grandchildren, and they wanted to move closer to them. Now their children were based in a nicer area, and they looked at how much they could sell their house for. They found a property that they wanted to move to, but they found that they basically didn't have enough equity and savings to be able to help them to move house. So the customer realised that they had to borrow some money, so they went into their high street bank that they had their past mortgage for, and after doing quite a long fact find, they were told that they couldn't borrow enough money, and they were too old anyway, so it was a bit of a waste of time. Fortunately, the customer had some friends who knew a broker who they referred them to, and the broker was able to go through a number of different options with them. They were both formal civil servants, so they had really good pensions, both in their mid to late 60s, and their incomes were good. So the broker took them through the option of a lifetime mortgage, and the customer felt the interest rate was a bit high. They were also concerned about eating into the equity of the property, because they really wanted to make sure they left a good sum of money for their children once they did pass on for their inheritance. So the broker took them through the options of a retirement interest only, where I think they needed to borrow an extra 50,000, which was purely on interest only, and they did the affordability calculator, which is on our website, which is quite straightforward to use, and it's the same one that the underwriters use, so it's accurate compared to, as long as you're putting in the I suppose the right information around income, which I'll go through with you in just a moment. And the customers were able to buy it to purchase this new home and to I suppose to bridge the gap for the loan amount that they needed compared to what they were able to sell their house for. So it's a really good news story for us that they were able to do that and use that product. So moving on, just talk to you a little bit about the sort of types of customers that we've identified from our research. So who's right for RIO? So we've talked about retirement planners. That's one of the ones that we just went through. Retirement planners, where they're either looking to move house or to look to draw down funds to help plan for their retirement. Then equity releases. I'd say for equity releases, that's where they're looking to draw down funds to do extra work to their home to make their home more comfortable for their later years, or if they're looking to go on a massive holiday, if they're looking to gift the money to give to their children, so that they can buy a property. That's the sort of thing that equity releases can do. I suppose the thing to look out for, they're not allowed to borrow the money for business input. Also, I suppose illegal, anything that's illegal, guns, drug money, gun laundering, stuff like that. That's definitely not something that we could help with. And then looking at existing interest-only customers, so this is another one that's been really popular, is customers who have got to the end of their mortgage and either don't want to pay it off, or can't pay it off, or don't want to have to move property or to downsize. That's something that we can help with in terms of existing interest-only customers who are just looking to keep their existing mortgage and keep up with the repayments. As long as they've got a sustainable income, that's the sort of thing that we can help with. So finally, just going to look through the actual proposition that we've come to market with. So we can lend up to 55% loan to value. There's no set end date, and there's a minimum age of 55 and a maximum age of 80 at application. So just going back to no set end date, when it comes to keying a decision in principle, you key it over 40 years, as that's the maximum term that our system will recognise. But there is no set end date. That's only just to get you through the decision in principle system. And also, when it mentions max age, that's only at application. As long as the customer is within that age range, they can apply. But then the mortgage will continue. If they were to live until their sort of 90s, even 100s, we will continue with that mortgage. There's also a maximum of 2 applicants. There's also no minimum equity required for this loan, and there's also no minimum income. The reason we've been able to take that decision is that it is a fixed repayment strategy, and the customer, it's a low loan to value, so the security from our side of things and the risk was reduced by that, which is why we don't need to have a minimum equity or income in place. So I've mentioned a couple of times around life events. We define a life event as death, leaving the property with no prospect of returning, acquiring another property for use as the main residence, and selling the property without transferring the loan to the new property. For the top two, death and leaving the property with no prospect of returning, in that instance, if the customer was halfway through a product, we wouldn't charge them any ERCs, we'd waive them, because that's not the sort of thing we would like to do. We just want to make sure that the customer's in the best position possible, and that their families are in a good position, so we would waive any ERCs if that situation happened. For the other two, in terms of acquiring another property, so if the customer moves away or buys another property, but they redeem the loan and don't port it across, because you can port it, then in that situation we would look to charge the customer ERCs. And also for a life event, where there's two borrowers, the life event is triggered by the sole surviving party. And then looking at the income assessment, so the best way of looking at the affordability assessment is working off the customer's worst case scenario. We can use current income, but we would normally be looking to use their projected pension income, including any transferable pension benefits which can be evidenced. So when it comes to looking at joint borrowers, always work off the worst case scenario. So if you've got a lower earner, look at what the transferable pension benefit will be from the main earner, and what their the lower earner would get guaranteed from their pension, and you can include state pensions as well. And then that's the sort of income that we'd be able to take. It's a little tip. One of the things that we have had is not enough information regarding the customer's transferable pension benefit. We've had a few general terms and conditions sent in, so make sure that your fact find just digs a little bit deeper and get the customer to get a quote from the pension provider of what the transferable benefit would be, and get it on a written headed paper letter to them. So I've gone through in terms of earned income pre-retirement. We can look to use both self-employed and employed income, but you need to sort of consider, is the customer going to be able to continue to earn this income throughout the rest of the term or throughout the rest of their lives? So for employed income, it's unlikely that they'd be able to use, so we'd be looking at pension benefits. But for self-employed income, if the customer is, I don't know, like a silent partner, and they don't actually do any work for that money that they're getting, so let's say for example they've had a building firm and now their family have now taken over 100% running of it, but they still are a shareholder, but they still get to get paid by that business, but actually don't do any physical work, then we could look to take that kind of income, because that income is just not going to stop. However, if they were working and were having to play an active part in the business, then we'd probably look to not use that income, because it wouldn't be seen to be sustainable throughout the rest of the customer's life. We've already gone through pension income. Something to mention on pension income: we don't accept drawdown pensions at present, simply because we haven't found a way of being able to prove what the customer would actually earn, and to, in terms of the guaranteed income. But it is something that we're looking at, so keep an eye out for that. Transferable pension benefits we've gone through, and then rental income and income from savings and investments. So we can use 100% of both of these, but again, the main thing to be thinking of is it's going to be sustainable through the rest of the customer's life. So if they've got properties and or an investment fund that they're having to actively manage themselves, then we could struggle to take that income, because it's possible that they may end up if they're having to actually do something to earn that income, then if when they get into their older age, they might not be able to continue to do that. However, if they've got properties that are being managed by a company for them, and if they've got an investment manager, again, that might be something that would be more likely for us to accept, because they're not actually having to do anything for that income. Right, in terms of supporting you, so we've got on our website, you've got our RIO hub, and that takes you through our guide to RIO, who's right for RIO, our 3-step process regarding how to do a decision in principle, an application, and how to get your offers, and then guidance on vulnerable customers, a lot of which I've already gone through today. There's a video from Jaden Green, who's our head of distribution, which talks to you about, again, vulnerable customers and how we've come back to the market, and also the RIO guidance notes, which I mentioned earlier in the presentation. I hope that's been of some use, and it's been enough information for you to consider us for your customers. Thanks very much for your time today.